So hello everyone. So today we are going to onboard to the stock market, the practical implementation session. However, when I thought of having the practical implementation session, there were a couple of things which came to my mind. So I thought, okay, before jumping to the actual market, let us understand maybe a few more things and the combination of some general guideline I can say, which I have developed based on my experience and which that is really going to help you. It is like, so we have learned, for example, the various component of the maybe vehicle or I can say the car, and we are about to take the car on the road. But before that, we need to aware of maybe certain rules, traffic rules, etc. The other unknown factors, the weather condition, etc. I mean, that is the some analogy you can understand. So we will definitely jump into the actual implementation session. However, at the same time, it is important to get aware of those additional concepts or guideline. So with all your permission, we will just have a look on onto those additional points, and then we can jump into the market. Okay. So okay. So before getting into the further detail, the one principle which always will keep on discussing about the whatever about the stock market, the trading. It is basically the result of certain processes, rules, and principle, or the methods or techniques, right? So whatever we are going to, uh, follow, that will that is going to give us the result. Okay, so we need to take some conscious effort to learn those methods and principle, and then rather than mixing our own thoughts when we will enter the market, how to stick to those principle. Okay, so that is one thing. Second thing, that okay, there are certain myths and the facts, okay, about the stock market. I mean, some of them we might have discussed initially, but for the benefit of everyone, because those points are very very important, so I'll try to reiterate, or maybe some points will be really new. Okay, so here are some points, right? One is related to myth related to our mind or the mindsets. Okay, so I mean, I when I met many even many experienced traders, I keep on hearing that I lose because I don't know trading secret. I mean, many of them are kind of uh, believes that there are lot of other secrets which is not known by as an individual, and because of that they are losing uh, money in the stock market, which is one of the greatest facts. Why people lose? Because they don't follow the system. I mean, initially they follow the system, and after some point of time, they miss, or they don't follow the system. It's like when we learn about driving, we always, for example, maintain a certain speed limit, maybe based on the guideline, like 60 km per hour or 80 km/h, or driving the left direction. Don't re- keep your speed maybe 30 to 40 when there is a school or the residential area, etc., etc., right? But when actually we take the car, we drive based on our own route. Okay, so similar myth is also in the stock market, that okay, the people think that okay, I'm losing because there is some secret which is not known. But the fact is that they are simply not following the system, and that we are. I mean, lot of system we learn. We are going to learn those system together in a is kind of integrated way. Second myth is okay, that only the intelligent people makes the money in this stock markets. So here it is not about the intelligent, it is about who is following the rules, who is following the right process and methods, entry, exit, stop loss, etc. that we are anyway going to discuss. And the set of myth is about myth of fortune. So maybe people thinks that okay, I'm not lucky enough into the stock market, that is why I'm losing. So and there's the same thing. This is not about the luck, it is about following the right process and the methods. Under capitalization is a simple thing that okay, stock market is only for the big people. Uh, but that is not the true. Based on my study about the stock market, even lot of good number of Indian people are there. I can name a few. I mean, one great Indian trader or stock market champion is the late Mr. Rakesh Jhunjhunwala. So he has a very humble beginning. He started, I think, around just a few thousands of rupees. Uh, uh, Rakesh Damani, the owner of DMart. So now he's a big businessman, but his starting points are not the business. He came from the stock market. A few more I can name it like Vijay Kedia. If I remember the correct, his Kedia is surname. I think he's a Vijay only. So he is a guy, I mean, I can say 50 plus years of age. He started with the 5,000 rupees. He's a Calcutta based person. So whatever the name I'm taking, you can Google it, and there a lot of interviews are there in the YouTube. You can go through that. So everyone has a very, very humble background. They started with a couple of thousands of rupees, and and now they are very well known in terms of in the stock market. And everyone started their career with a stock market trading. Now they have one of the biggest name in terms of investors, or some of them are turned into businessmen. Okay. Next one is the autopilot myths. So autopilot myth, I mean, there are some, trading systems are there, which is helping us a kind of a automation mode or some, okay. But that is not the only things. Even whatever the name I just took, everyone is doing their trading manually, and they are doing a very, very, very good. They are making, they had made, in fact, very good money from the stock market. And the one is myth of fundamentals. I think this point I have already touched, but again, it is worth to reiterate that okay, stock prices is not determined by the company. I mean, once it is listed in the public forum, there it is there is no impact on the company's fundamentals or the how good or bad they are doing. I mean, they are, but when it comes to the technical analysis and actual stock market, company's past performance or the company's fundamental uh, has no direct relationship. Next one is the myth of brand. So sometimes people has very much kind of association or the some soft corner about some particular stock, maybe for a particular company or sometime particular brand. Okay, so they think that okay, if I invest in so XYZ company, then only I will make money. It's not like when it comes to technical analysis, it doesn't matter. Okay, what is the brand or what is the company? Right. Here, only one point it mentioned that there should be a good volatility. Volatility means that a good number of people should be participating in that particular stock, and that is enough for us to select for the trading or investment purpose. Right. Uh, Next one is that it's a kind of a hard fact, as I'm just sharing that okay, markets is not none of us mother. So what it mean that um, there are in the market there are very I can say professional gamers, right? So they are just playing the their game, okay, and there is no one who really cares for you. It is us as an individual who need to take care of ourselves, and that taking care of ourselves means following the right system and right method that we have learned so far, and we are going to learn in next couple of sessions as well. Okay. um and again, some so this rule is for the whenever we learn about the futures. So in general, stock market is we can say zero sum game. Zero sum game means somebody winning and somebody losing, right? But the futures trading is kind of a, minus sum game. Minus sum game means you can lose more than what you are going to invest. So for example, in the typical stock market or equity trading, you suppose if you have invested 100 rupees, maximum we can lose is 100 rupees. But if you are trading in a futures, options or some other way, it will be you may lose more than your investment. Okay, so that part, when we learn about the futures, we will understand more, right? And other thing that stock market, so typically stock market attracts many, okay, and they lose because again the same thing, that okay, they enter into the markets because without any proper knowledge. It's like somebody got a brand new car or brand new bike, and without learning how to drive the car or bike, they are just trying to do something. I mean, in the car, if you are running, if maybe taking it to the cricket stadium or a open ground, it may be possible that you can able to drive for a certain distance because there is no traffic and all. But if you take the car in the real traffic, there is a higher chances that you may met with an accident. So same thing about the stock market. So these all things are very, very important. That is, I'm just reiterating. And why? Because in the stock markets, money is equivalent to our life. Once we lose money in stock market, it is equivalent to losing the life. Okay, so that's the reason I'm just trying to reiterate those points which I have accumulated based on my learning experience. Let's have few more points. So a lot of time from the newcomers, I heard these questions, right? Right. What stock should I buy and when? Which company, IT company, or the banking system, banking company, or anything else? And is it good time to buy? Okay. Is market is falling, so should I sell or hold? For example, recently we have seen the big fall in Adani's. So a lot of questions keep on coming. What should I do? Even the recent one, uh, 2 days back, one of my college friends started asking about the S Bank, um, and he purchased based on some news. And at the time, the news was the S Bank is going to, or I can say SBI is taking over the S Bank. And that point of time, the S Bank share price was 80 rupees. And it was that point of time, it was falling market. So maybe 242, or it fell down to 80 rupees. And he thought, okay, it is a really cheap and it's a good time to buy. And the current situation is that the S Bank stock price is around 10 to 12 rupees. Okay. So because he purchased those stock based on some news or some friend suggestion, and ultimately he is in big trouble. I think he has purchased 3,000 or 4,000 stocks. So 80 rupees to 10 rupees, you can understand it's a more than 80% or around 80% of his investment kind of vanished. Next point is this a bull market or bear market? How to identify that? Okay, how high or how low that stock could go. So all the answer of all these questions is simply knowing about the technical analysis and with some additional money management rule, which we are going to learn in the subsequent discussions. So if in between, if anybody has any question, feel free to ask. So, okay, so far we had a lot of discussions about the market, some uh, principles, some concepts. So let us try to find out answers. Okay, so here the question is, the simple question is, market rise when? Okay, our market is rising when? So there are four options. Okay, there are more buyers than sellers. Buyers are more aggressive than sellers. Sellers are afraid and demand a premium. And the fourth one is more shares or contracts are bought than sold. So based on your understanding or discussion so far, please maybe you can unmute yourself or maybe type in your response in the chat box. What do you think is the right answer of this question? When market rise or when market goes up, what do you think is the correct answer or correct set of answers? So there are the four options: A, B, C, D, E. So please type your answer in the chat box. Okay, so Mr. Avdesh says A, that is first and second. There are more buyers than sellers, and buyers are more aggressive than sellers. So we have 6 participants. Any other answers apart from Mr. Avdesh? That and he's suggesting option A. You can type in the chat box, or you can unmute yourself and speak and maybe share an answer. So this is very one of the important question. But what is our understanding about the market? Why market goes up? Okay, so let us understand. Okay, there are more buyers than sellers. So even in the market, suppose there are the more buyers than sellers. Okay, so Hina saying that B, that is second and third. That means the buyers are more aggressive than sellers. Okay, and the next one is sellers are afraid and demand a premium. So Hina, maybe could you please unmute yourself and share what made you think that the option B is the correct one? If you don't have any limitation of speaking, I would
Hello.
request. Yes, please go ahead.
Yeah, when buyers are more aggressive, there may be more demand.
Right.
Yeah, and this is when there is a more demand, the market will rise.
Correct. But along with the B, there is a two options, second and third. So your answer is correct. I just wanted to understand the second option, buyer are more aggressive than the sellers. That is the correct one, because so demand is more than the supply, or the buyers are more aggressive. They want to buy more and more. What about the third one? So your answer is correct. So sellers are afraid and demands a premium. Would you like to add any explanation for that? Okay, maybe here, just to benefit of time, I will share. So let's take example of a land. Okay, so suppose somebody purchase a land maybe in a outskirts area. Okay, and then maybe the land costed, for example, one CR, and after 3 months, because the guy has done the investment, after maybe couple of months or year, nearby that land, suppose some other industry or some very good developments are coming, right? So in that case, so seller seller might think that, okay, the price is, if I don't sell it, or it is the right time to sell. So they have the kind of effect of the market. Okay, the nearby something is coming, let us sell it out, otherwise I don't know what will happen, that industry will come or not. So based on those additional factors, they try to um, sell it with some premium. Means maybe if they have purchased in one CR, they may ask a higher price. Okay, maybe 1 CR and maybe 10 lakh additional or 20 lakh additional, something like that. Okay, so that is the kind of explanation. At the same time, it might be, there might be also situation that near that plot or land, there is a government garbage dumping yard is coming, like where these all the cities garbage is being dumped. So rather than the price going high, the price of the land also go down. Okay, so this is the kind of explanation about when why that market is going down. So similarly, sorry, going up. So going up means there is something
I
good
don't know.
development.
For me, the voice is breaking. Is it breaking for others too?
Uh, yeah, can anyone else please also confirm if voice is okay or there is a
We
disturb.
can't hear you properly, Sachin.
Okay, maybe I'll just try switching off my video if that makes it better. Can someone confirm that if you can able to hear my voice properly or there is still some disturbance? Hey, hello everyone. Sorry, looks like there was some uh, disruption, disturbance in the network. Can can someone confirm if you can able to hear me properly?
No, Sachin, we can't hear you.
Ah, okay. So actually, I am at near my native place today, near Varanasi. So there was some storm in this area.
It's slightly better now. Why don't you continue? Sachin, it's slightly better now. Please
Okay,
continue. Let's see.
okay. Yeah, thank you. So I was explaining about the why I mean this what is the scenario when the price will go up. So one thing that okay, yes, buyers are more aggressive than seller. That means demand is higher than the supply. That could be one reason that okay the price is going high. And the second part is that the sellers are afraid and demands a premium. So what that it mean that whenever a seller wanted to sell their stock, okay, so they have a kind of a fear that okay if I don't sell, what will happen next? And because they have purchased maybe a some lower price, they always expect that okay that because I'm selling, I should be having some profit. And more if the similar mindset will be there for the all the sellers, most of the sellers, that means they will always put some additional money, additional costs on top of at which they have already purchased. So these are the kind of two primary reason which which uh, force market to go up. And if the similar result will have, if the similar thought process will be happen in negative way, for example, if there are more seller than buyer, so definitely the market will fall because most lot of people are just planning to sell their stocks, and there will be a less buyers. So that means they need to put their price lower than the market price, and that is how the market or the price of that stock goes down. Okay. Yeah. So few more things, few more points that okay, what is the retail mindset? Right. So retail mindset means the individual, investor or the trader, people like maybe you and me, who are not who don't have very big pocket. At the same time, uh, even there are people even they don't have a big pocket, but they have the big mindset. Okay, so this is the example of a typical I can say retail mindset. Okay, what they are doing that they are their portfolio means suppose we have invested into the multiple stocks okay of different sectors. And what what will happen that in typical scenario that rather than uh, purchasing a stock depending on technical analysis, some they purchase stock depending on some market news or based on their liking. They like some XYZ company, and then based on their liking, they purchase it. Okay. Even sometimes they purchase wrong stock rather than, a kind of a selling it based on the stop loss, whatever we are, whatever the system they have learned or followed. They try to become brave that, okay, let's see what will happen. Right. So that is the another retail mindset. Sometimes uh, retail mindset, they prefer to buy cheap. Okay, so so XYZ stock is now in a very cheap price or low price. Let us purchase that. Right. Others sometimes also happen that, okay, they purchase something on a higher price, and then when the price is coming down, they try to average it out. Averaging means that, suppose somebody purchase any stock of 100 rupees per share, and the price goes down to 70 rupees. So rather than exiting, they try to, now it is become 70, so it is become more cheaper, let's purchase it. So that the average value of the individual purchasing price should go down. So that is called averaging. Okay. So these are the few points which is kind of a, impacting the retail, the individual retailers, and which is kind of a, you know um, making, rather than making a profit, it will result in a kind of a losses. Okay. So
So
yeah,
are you saying that these are not good behaviors? None of this
yeah,
should be done.
correct, not, yeah, not, yeah, none of
But
them are
averaging is
good.
a very normal strategy, Sachin. Many people say, okay, let's just average.
Correct. So that is why I'm telling you that don't follow the many people.
Okay. Okay.
Okay. So right. Again, a trend, I think we have understood the trend. So what we are trying to just reiterate that, okay, trend is a friend. That is one slogan. So trend is always a friend. So our main motto is to identify the trend. It is the uptrending market or downtrending market, and based on that, align ourselves. Right. And it has been since many years. As per the stock market, uh, international, stock market history, this is more than 250 years. So whatever is the trend, just we need to align with that. We should not be fighting with the trend. And the overall main motto of the learning about technical analysis is to understand what is the trend. It is the uptrend or downtrend, and based on that, just align with them. What are the major forces? Just we need to just align with them. That is what the main purpose. Okay, so few quick recap about the, bulls versus bears. Right. So okay, this is just a snapshot I captured. So this is the one old kind of black and white movie days. So here in this image, the white one is the equivalent to the green candle, and black one you can consider the red candle. Okay. So any green candle or white candle is a long solid candle, so it is typically a bullish one, and any red candle or the black candle is typically a bear candle. That is a simple, very simple. Second second one is that, okay, if there is any candle which is having just a small body, no matter of what is the color, that means that, okay, this is the kind of a neutral candle. We cannot say that, okay, what will be the behavior. So we need to stop. We should not be taking any decision whenever there is a small body of the candle. Okay. The fourth type of candle is, so here is the long wick downside and the small body. Okay. So here in this fourth example, the color of the body doesn't matter. Only we need to consider the wick. Okay. So if we look at the wick, there is a long wick below. Okay. So typically this is the example of, we know that it is an example of hammer. But just by looking at this, even we don't remember what is the hammer, bull or bear. Just by looking at the understand what is happening. So what it mean that maybe the price may have fallen down, but the end of this candle, when candle got closed, the bulls again fight back and push the price up. It's a very simple definition or understanding that, okay, if the wick is downwards, long wick is downwards, that means bull has had a good fight and they push the price up. So that is how this we can remember the bullish candle. And the opposite of that is the fifth example, that is an inverted hammer. uh, okay, and how to understand or remember is that the price went up when this time frame or in this candle started forming, but before closing of the candle, the bears fought it back and pushed the price down. So that is how the inverted hammer formation is happening. Okay, and the sixth example is kind of a neutral candle where we can see the long wick both the sides. So what it means that a good fight has happened between bears and bull, and the result is kind of a undetermined, means that, okay, both are kind of winner, or you can say the tie. So I can say again the neutral one. Okay, so based on whenever we can see such kind of candle, we can wait for next candle to form based on the candlestick pattern. Here there's under some example of the hammer example. So the first example we can see that the typical hammer example where the long shadow or long wick. So shadow and wick are the same thing. Downside and upside there is a small body hammer, and the same hammer if found at the top of the trend, okay, top of any chart, in a stock market term, it is also called as a hanging man. Okay, so I mean the position of that candle also matters. Okay, so when the same thing is found at the top, so that it is kind of a showing a maybe a potential bearish reversal. Okay, and followed by a confirmation candles are there in the red color. That is the second or third confirmation of the bearish reversal. So this is just a quick recap of the few important things we will be learning how to implement them. Oscillators that we have learned, I think, towards the end, in last to last sessions, and I can say last two sessions. And a few more, just a quick example I would like to share that, okay, how to read that oscillator. So oscillators, anybody remembers what are those two oscillators that we studies? So one was stochastic and the other was RSI, right? So based on the oscillators, so there are two concepts that we learned in the past, that whenever these oscillators are moving, above 80, then it is called those at that situation it is called the overbought zone. Okay, and many a times what is happened that, okay, when these oscillators are there in the overbought region, sometimes they spend a good amount of time in the overbought zone. Okay, and depending on this oscillator's status and the price range, there is the other indicators that, okay, how, at what basis we can say that, okay, when that reversal will happen. And then we learn about the divergences, right? Bullish divergence and bearish divergences. So along with the oscillators, the divergence concept is there. Okay, so overbought, as of now, just understand overbought zone is when the oscillators are there above 80, and those particular range is called the overbought zone. And similar way, when these oscillators are running below 20, and so the situation is called oversold zone. So in practical, there is nothing called overbought. I mean, the number, all in the stock market, number of sold share will be always equal to number of bought one. But in technical analysis, there's an understanding term that if these oscillators are moving or oscillating above 80, that is called as overbought zone, and these oscillators are moving below 20, that is called oversold zone. Okay, and how to use them? Like, so whenever we can find divergences, for example, let us see this example like so let us first look at the what is the overbought zone. So in the overbought zone, see these oscillators are kind of above 80%, and above 80, not percent, above 80. And when there is a kind of a bullish divergence, that means the price is going a higher high. That means the price is making a new high as compared to the previous high, but oscillators are kind of making a lower low. That means oscillators are not in line with the price. So there is a potential signal that okay, there might be a trend reversal. And in this example, we can say both the oscillators are making lower low. At the same time, price is making higher high. So that's the indication of this. Okay, this particular stock um, has a potential to go down. And same thing about the so one is about the sorry bearish divergence, and there is a bullish divergence. So bullish divergence means that in a falling market, when the price is making lower low, at the same time these oscillators, both the oscillators or any one of the oscillators is making a higher low. That means the oscillators are not in line, not along with the price. Price is going down, but the oscillators values are going not going down. It is a based on the as compared to the previous low, it is making a higher low. Okay, so that means there is a potential chances of bullish trend reversal. So market means will not fall down. It is a potential chances that market will go up. So this is the quick reminder of divergences along with the uh, these two oscillators. Okay. Next one, we are going to just have a quick recap about the time frames. So as we know earlier that there are time frames starting with a monthly chart, then weekly, daily, and for intraday, it is from the 1 minute to 15 minute or 1 hour. So these are the various time frames that has are there in the stock market. And if we select any candle in any time frame, so individual candles represents that particular time frame. Okay, so if it's a monthly chart, that means one candle will represent a 1 month of duration, and similarly 1 minute or 15 minutes candle will represent 1 minute or 15 minute of duration. Right. So the another example of time frame, what to remember is that the long so as per the Dow theory, we know that okay, there are just a three trend, uptrend, downtrend, and the sideways. So for a long term trend which is lasting for a several years, for example, if we if you select any monthly chart, okay, so monthly chart means that at a one point of time, so monthly chart means 12 a candle will represent our years. Okay, so even it is just for example 50 or 60 candle, it will represent a couple of years. All right, that is a really long term. Okay, so whenever we say that about the long term means we always will be several months. I mean 3 months, 3 years, and maybe beyond. In that general term is called a long term. Anything medium term means it will be kind of a few weeks to maybe a 2 to 3 years, and short term will be a really short term, maybe for few hours to few days. So in the stock market or maybe in this technical analysis, we are going to use three terms. So it's a very really long term. We are saying at the tide. So tide, just for a easy remembrance, tide understand about the real tide happens in the ocean, right? So where the big it's kind of a water level goes up and down. It doesn't happen every day. I mean it may happen couple of days or couple of weeks, right? So those are the, consider the tide. We can just comparison purpose. Wave means it is happening kind of, every minute or maybe every day waves are coming down. So that is a wave. And the ripple is the really, small things. So once we, for example, once we throw any stone in the river, the small waves are coming, right? So those are the ripples. So tide, wave, and ripple, just for understanding purpose, have a consideration that, okay, tide, whenever we say tide is the long time frame, wave is the medium term time frame, maybe a few days to, few weeks, and ripple is this very, very small time frame. It will be from a few minutes to, uh, a few hours. So that is the wave, sorry, tide, wave, and ripple. Because in that, when we are going to learn about implementation, we will be using these keywords interchangeably to, for a understanding purpose. So that is the reason I'm just giving you, these how to understand about the time frame against this tide, wave, and ripple. So tide is again the big time frame, wave is the medium term time frame, and ripple is a very smaller time frame. So what is recommended is we need to always trade in the direction of the tide. Okay, so what is the big time frame is telling? And take the advantage of wave. So it's like a surfer. So surfer always find out the wave and they ride the wave, right? So whenever we say tide means what is the bigger time frame, and the wave is the smaller time frame, or maybe the daily chart or so, and the breakouts or the reversal in the ripple. So um, we will learn more when we'll, uh, start looking at the real charts. Okay, how to use these terms. So as of now, just understand tide, wave, and ripple is that big time frame, medium time frame, and a smaller time frame. And that's all for the understanding purpose. Now, again, the few more kind of a theory or the gyan that I would like to share here. So this is kind of a generic representation about the what are the three mantras or three M's from the stock market. And the biggest contribution goes to the mind management, which is more important than anything else. A mind management followed by the money management and the method. So, sorry, mind management, method, and the money management. So, method, that is what we are learning. So, I mean, that is for building a more confidence. But lot of time, what's happened that even we learn the right method, but when we enter into the market, we do a lot of mistakes. So that's the reason I'm stressing a lot about the mind management. That okay, when we enter into the market, our mind most of the time mind will tell or try to force us that okay, don't follow the rules. It's like when we are waiting at the traffic signal and when we don't find any of the traffic police, we try to jump the signal. But we know that okay, this is against the rule. So ideally, we should be following the rule. Otherwise, there are higher chances of meeting with an accident, right? So that is all about typically 3 M's that will practice more and more. But as of now, just try to think that okay, whenever we learn whatever the method that we are learning, let us stick to those methods. Don't allow your mind to overrule on those methods and do the mistakes. Money management is another thing that we are going to learn. But here, as of now, the quick thing is, for example, if you have, for example, maybe 1 lakh of rupees to start with, uh, I would suggest that okay, don't invest more than 10% in one particular stock. So maximum investment on any particular individual stock, you should be doing 10%, not more than that to start with. Once maybe you are more confident and have more practice, then maybe you can change the rule. But to start with, just remember the 10% rule for any investment on any particular stock. Yeah. So to elaborate that, three methods. The first method we learn about the, method. So method is called this is called a triple screen system. Okay. So what is triple screen system means that the first screen that what we are going to check is the long-term view. Okay. So whenever we are selecting any stock, we need to have the long-term view. What it mean that if I can able to show you quickly. So let's take an example of any particular stock. Let's take, for example, the Wipro. Okay. This we don't need. Okay. So whenever we are planning to trade any with any stock, we need to have first long-term view. That means knowing about the entire history of that particular stock. So if I take that example of knowing the history means is the selection of the stock is kind, I can say, selection of the life partners. I mean, in an Indian traditional system, when there is a arranged marriage of concept, so people try to understand about the maybe their family. When our elders try to understand about the and not about that particular person, but I mean the family history. So similarly, to select the stock or before trading the stock, we need to know about what is the entire history of that particular stock. So if we look at this example of Wipro, uh, maybe it has the, I can say, uh, kind of a good performer uh, after this COVID, but there is another kind of a fall. So maybe to start with, it is not giving a very good sign. I mean, it's looking like outperformer, but after that there is a complete reversal happen. So maybe to start with, it may not be very much appropriate. Somebody may think that okay, the Wipro has fallen down. It is right, maybe a time to entry. Uh, but I would suggest that okay, maybe as a high level, it is not. So when we learn there is a step by step method how to select, but looking the high term, I mean long term view or the complete history of the stock, it is not giving a very good um, you know impression of the investment also. Okay. Let us maybe choose some other stock, just random. So okay, let us choose maybe the Infi one. So when we look at the, for example, Infi stock is refreshing. So if I'm looking at the Infosys stock, maybe a longer term chart, uh, weekly, or maybe if I can select more higher time frame. So by looking at the history overall, since the I mean since the beginning, it's kind of outperformance. Giving is going to higher highs, making a higher high. Maybe since 2001 or so, right? And even after the COVID, it is really very good jump happen. Okay. uh, so it is like one of the kind of a clear outperformer. Currently there is a big correction is happening. Okay, so there is and we also learned that okay, any stock will not move always in a one direction. There will be some intermediate resting will happen. How much it will rest or how much it will correct, there are some other things that we learn about the Fibonacci retracement, etc., etc. So so that is so what we are learning is that is the understanding of the long term view of any particular stock. So when we are looking at any stock, have the kind of entire history as long as possible before making a next move. The so that was the you know long-term view of that particular stock. And second one is the invest or trade in the direction of the main trend, right? And then use the slope of MACD. So we have learned about the MACD. Okay. So what it mean that, for example, so now we have RSI stochastic, and let us look about the MACD. Okay. So so here, if I remove this RSI and other indicators, so just only look at the MACD and this particular stock. Okay, so MACD has done the negative crossover at this point of time even. Okay, so what it means that since March 2022, this particular Infosys stock uh, has indicating of for sale rather than the buy. Okay, as per the simple MACD. And so that is the having, I mean, kind of a long-term view. The long-term view is saying that, okay, since last more than 1 year, it is better to sell rather than purchase. As of now, that is the simple meaning of the use the slope of MACD to identify the direction. We look at more and more example, but as of now, we are just having a quick recap. Okay, so that is the first screen system. Second screen is we are going to look at the medium term. Medium term means even a big. So here there we looked at the maybe a monthly or weekly, but medium term means what is the market wave. So very long time is saying market tide, and the medium term is saying what is the market wave. So market wave means there is the, so when we are looking at the chart in the monthly time frame, but so the trading actually will happen in the lower time frame, because we are not going to sell or purchase any stock in a monthly. When we are purchasing, we'll be purchasing in a daily time frame. Maybe we'll be purchasing today or tomorrow. So that in some particular moment. So that means we need to come back in a lower time frame. So it could be a daily or even maybe lesser than that, right? So once we have decided the long-term market movement for the tide, to identify the tide and to have the trading execute the trading, we need to come to the lower time frame. That means the either daily or maybe 4 hourly or so. Okay, so that is the region. I mean, that is the main that, okay, this is the time frame we want to trade, and identify the wave that goes against the trend, or it would say that pull back on a daily chart when weekly trend is up. So okay, so what it mean, let me look at. So MACD one is done. So we need to have those two additional indicator that we learned, that is the RSI and stochastic. And please don't worry. I mean, if somebody having any confusion, maybe once we start the when we select one stock and then try to there is just is kind of a predefined checklist. When we'll go by the checklist one by one, we will understand more. As of now, the main idea is to have those understanding of what is meant by the tide, wave, and ripple. So tide means equivalent to say the MACD, which tells the main market movement. So when we are looking at the tide means we are only looking at the MACD, and as per MACD, some negative crossover happen, and it is market is in the kind of a downfall or downwards direction. So once MACD is done, we should be looking at these two, like RSI and the stochastic, in a lower time frame. That means the daily time frame, for example. And to to have the to get that understanding about the uh, what we should be doing. So for example, in this Infosys chart, so the higher time frame is saying that okay, sell it. Okay, so whenever we are planning to sell in a daily time frame, we need to identify the opportunity of the negative crossover from stochastic, or the RSI should be on a higher side. Okay, that is what we learned when we were discussing about RSI. Like when we should be selling any particular stock when the RSI is the down tick, or the stochastic is making a negative crossover. That means the blue line is crossing the red line. So even maybe if somebody having any confusion, either please look at the recordings of these oscillators, or we'll get more clarity when we try implementing this in the real market. Okay, so that is the about the second screen, that is the medium term. And the third screen is short term, that is or the ripple in the direction of the tide. So what it mean that, so so we can, so the ripple concept, you can use it or don't use it, it again depends on the individual. Okay, what it mean that, so even after selecting a daily time frame about when to buy or sell in this example, because it's a downwards or falling market. Okay, so basically it is always indicating that okay, to do some sell. So we can even go to the lower time frame of 15 minute or 5 minute to have a to refine your entry. Okay, so here I have selected the 15-minute time frame. Okay, so within the 15-minute time frame, the again the same ideal time would be when RSI is showing the down tick, or the stochastic is showing the negative crossover. So that will be a ideal time to sell, right? So this is the one simple kind of method of using the triple screen system. Triple screen system means there are three individual um, indicators we are looking at, or in order we are doing the three checks, and the all checks should be telling the same thing, that okay, yes, either in the uptrending market all checks should say okay, buy or buy, or the downtrending market all the three checks should say sell based on those checklist, right? And choosing the time frame, like which time frame as an individual we should choose. So for in general, for a medium term investor, it is recommended to use the weekly, daily and hourly. So when it means weekly, daily and hourly means, for a tide we should be looking at the weekly time frame. For a wave we should be looking at the daily time frame, and for a ripple 1 hour time frame. For a day trader or intraday trader, okay, so intraday, that means someone is purchasing or sell or entering into the market uh, in the morning, and by evening they are exiting. That is the definition of a day trader, right? So for any day trader, for them 1 hour should be a tide, 15 minutes should be a wave, and 5 minutes should be a ripple. Okay, so when we learn about implementation, we will be taking all the combination of the examples, like a long-term investor, medium-term investor, and a day trader. So depending on your appetite or your availability, you should be able to trade in a different ways. From a long-term couple of years to maybe couple of hours. Okay, so all type of example we will be uh, taking. Right. Few more things that okay, how to determine the entry. So as we discussed, we will be using a triple screen system. That means we should be checking the MACD in a higher time frame, and the stochastic and RSI in the medium time frame, that is the wave, and Ripple also, just to refine more, have a more refined right. At the same time, we need to also think about the losses before thinking about the profits. So where that the stop loss concept is getting introduced. That okay, for any taking any decision, we should be having a very clear cut idea that okay, at what point we should be exiting in a both the scenario. Either it will hit the profit or it will hit the stop loss. So both entry and exit should be determined before taking the trade, right? And target again, target we should be having based on the chart pattern. So chart pattern we have already learned. So based on the chart pattern, we should be having the target ready. Okay, it's not like once we take the entry and then decide. Based on the analysis we do, based on the analysis we have the line mark. This is the price point. I will be taking the exit. Either it should be the target or this should be the stop loss. All right. So typically, what is the reward? Reward is very simple. Whatever the target that we have chosen and minus the entry. So for example, our entry point is suppose 100 rupees and target is 130 or 150. So that means 150 minus 100. That is the reward. And risk is again the similar thing. Maybe entry is 100 and we are I'm sorry about the interruption. So looks like there is some unstable network due to the recent weather condition. Uh, can someone confirm if you're able to see my screen? Okay. So I was mentioning about the determining the target and stop losses, and then so target means that at what point we need to exit that point, and stop loss means if the trade is not going in the desired direction, a strict uh, level should be there that okay, I should be exiting at that particular level. So that is stop loss. And I was mentioning about the reward. Reward means that okay, whatever the target that we have decided based on the analysis and the entry price. So that difference will be the reward. And risk will be the again opposite, the entry point and the point stop loss point. That difference will be the risk. Okay. So it is to start with for a beginners. What I would recommend that okay, based on the analysis, when the reward and risk ratio is more than 3, then it is recommended for a beginner to take a trade. Okay, so that means that okay, if we are doing the analysis and stop loss and the target. So for example, if you are um, investing maybe 100 rupees and target is for example 130, and then um, uh, kind of a stop loss is 100, sorry 90. So 100 to 90 is 10 rupees and 100 to 130 is 30 rupees. So minimum that should be the risk and reward ratio 1:3. It should be a more than, so 1 rupee risk against 3 rupees of profits. Okay, so that is the recommended uh, kind of a risk reward ratio for any beginner to start with the trading. Okay, and the next one is that stock should have enough liquidation. So what it means that there should be a good number of purchaser and sellers. Okay, so participants should be there enough. That is the another selection criteria for any stock. And there is that whatever that we are, uh, you know, the checklist. I will be giving you the combination of 7 to 8 checklists. So there should not be any contradictory signals. So whatever the checklist that we are going to learn, all the checklists should give the positive or in favor of our analysis, then only we should be taking the trade. If any one of signal is saying going against the other one, we should not be taking the trade. So what it mean that if I went to buy or go long, so there should not be any indicator which should tell the sell signal. What is mean by buy signal, sell signal? Once we understand those individual checklists, we'll come to know. And the same and a few points related to the exit that we should sorry. So so exit pointer do not exist just because your target is reached. The stock may go up or down further. Okay, so there is there is a few more criteria that that we are going to learn. Okay, so the target, defining the target is one, and that additional concept is called trailing or stop losses. Right. Uh, and then exit when your exit signals are hit, right? So those exit signals are depending on the various concept, that is it may be depending on, sorry, give me a second, let me have some water please. So there are the some various criteria that we are going to learn to take the exit, right? And some some there will be some additional signals which will uh, help us for the selling purpose. Selling, it could be a selling or it could be a short selling. So for selling purpose, there are a few more guideline. I can say that okay, I mean we learned earlier, but it is again the reminder that we should not be feeling any emotional about any particular company, because that particular company is not our partner. So based on the technical analysis, if those analysis suggest that okay, we should be purchasing or selling, then only we should be taking that trade in any particular company. Okay. Um, and one very important thing that okay, so many times we think that if we don't take a decision now, we may able to miss the chances. Is not the condition. Market is there since 100 years or more than that. It will be there for next 1,000 years. So even any particular point of time, if you feel that okay, this train, I mean, there is a delay, then better not to take a trade. Just wait and relax, or maybe you find out the another one, because sometimes what happens that okay, when we start trading, so the mind will force kind of a provoke you or tell you that okay, just take some trade, right? So if it is one like a uh, kind of a concept or theory, I say that okay, late to the party. Okay, so once you are late to the party and understand that okay, cake has been cut and the food has been eaten by the people, better not to join the party, be at home, right? So similar thing in stock market. If some delay has already happened, better not to enter late. Just wait and watch for the right opportunities. Right. So uh, so looks like I have already overstood the time. Just last concept for the day. So choosing the stop losses, right? So at what these are some factors, based on that we should be determining the stop losses. Maybe the identify the immediate support, or maybe this is for the bulls, and resistance for the bears, right? So and what could be the maybe the next support or resistance if that is crossed. So these okay, stop loss should be below or immediate or the next support level. So whatever the I'm telling, it is more of the theory, again just for the understanding purpose. Will use them to in the real stock market. I think I keep on telling, but have please have some more patience, maybe one or two discussions, because what will happen that, okay, these all theories we will be applying into the, in the real market, and it was very important to share these few additional concept or theories, so that at least we should, at least we are aware of, or we together on this journey, and then when we are applying, we can able to recall, and then we should be only focusing on the implementation part. And don't worry, I mean, if some of the concepts are is kind of a new, or you are not getting, um, we will, when we will have the implementation, the real one, we will repeat it couple of time, and then it will come into your practice. So again, it is like a learn, I mean, driving, it will take few more iterations to, to maybe balance your handle, and then drive it slowly. Right. So maybe for today's session, maybe I'll pause it here. We'll have just a few more, the one or two similar concept maybe tomorrow as well, and hopefully tomorrow or maximum day after tomorrow, we will try to implement those concepts in the real market, and then start taking the decision based on those checklists. So at this point of time, I assume that, okay, everyone's trading account has been set up, and maybe because when we will be discussing next day, or I mean, as soon as possible, you should be able to take maybe at least one trade, maybe by end of this week. So if anybody don't have the trading account set up, maybe please try to set up your trading account. Be ready with, uh, the opening of those accounts, and so that once we learn, you can at least next day you should able to take one stock of your selected company. So if there is any question based on whatever we have discussed today, feel free to ask. Any question from anyone based on whatever we have discussed today? Okay, great. So I'll assume